Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Peter Schiff, founder of Euro Pacific Capital, as well as the Peter Schiff Show. He's also over Schiff Gold. Peter, you're into a lot of things. What you up to nowadays?
Yeah, well, since I started Euro Pacific Capital, I've since basically sold that broker-dealer, and now I have Euro Pacific Asset Management.
Yeah.
And so that's my asset management company, and then Schiff Gold, as you said, is the gold company. But no, I've been doing well. It was nice seeing you up in New Orleans, right? I guess for me in Puerto Rico.
Yeah.
But a lot of action, in the metals market, both while we were in New Orleans and now in particular since we've come back.
Yeah, for sure. Yeah, there's been sorry for butchering that earlier with Euro Pacific Capital. I remember you speaking about your experience with that, but Euro Pacific Asset Management, because you all have gold funds and with the commodities tied to the commodities and such, and so
yeah, exactly. We have separately managed accounts that focus on global investing. One of the strategies is a precious metals mining strategy. But we also have 5 mutual funds, one of them being a precious metals fund. But we also have a dividend payer fund, value fund, emerging market fund, and a global bond fund.
Yeah. And so you've always talked about these U.S. assets being overvalued. Recently, Ray Dalio put out a piece about the Fed stimulating into a bubble, which had a lot of concerning dynamics there. And I was reading on the recent Fed report that they are stopping quantitative tightening, and I'm suspecting that they're going to start easing, especially as we've seen some stress in the repo market. People are coming, hedge funds are coming with these treasuries and for collateral, and it seems like there's an oversupply of these treasuries, and they're needing liquidity and such. And so we saw that recently with the stress in the market, and so I want to get your perspective on what's going on in this particular part of the financial realm.
Yeah, I expected them to end quantitative tightening some time ago, so they held out longer than I thought, and I agree that it's a precursor to going back to quantitative easing. It's only a question of time before the Fed capitulates and does that, and I think part of the pressure is going to come from rising long-term interest rates. Even if the Fed continues to cut short-term rates, I believe that long-term rates will rise. And that's going to be very problematic for the U.S. government, for the housing market, for the overall economy with so much debt out there. And I think it's a problem for the financial sector. And in order to alleviate that, I think we're going to get a return to quantitative easing. And that just means much more inflation, higher consumer prices, and ultimately higher long-term interest rates too, because higher inflation erodes away the value of bonds, and investors demand higher rates for holding on to them.
Yeah. So looking at quantitative easing and the damage that it's done to the economy, I mean, it's distorted, the economy dramatically. When you look at the difference between Wall Street and Main Street, and these asset bubbles just continue to be inflated and such. So with the Fed on course, I mean, stopping quantitative tightening and then seeing these liquidity strains, and then also we have multiple things coming up. I mean, we have the Supreme Court decision on Fed Governor Lisa Cook, as well as Jerome Powell's term ending and such. And so, it seems like Trump may get his way. I don't know about Lisa Cook, but it seemed like he may get his way with lower rates and quantitative easing.
Well, I don't know how many rate cuts the Fed is going to be able to deliver, but I do think we'll have quantitative easing. But again, that's not a good thing. That's just more inflation, and it's just meant to prevent a collapse. But we end up taking our medicine in a different form, and I think it's actually worse. So it's not going to be a good thing. The Lisa Cook situation, I think that if the Supreme Court upholds Trump's right to fire her, I think that's a negative for the dollar and for a loss of Fed credibility. Because if he could fire Lisa Cook, pretty much going to say he could fire anyone he wants. That, it's really up to his discretion to define what cause is. And, if it's just because he doesn't like her policies, that's still going to work. Because it's pretty clear that he's not firing her because of the mortgage situation. The only reason they know about the mortgage situation is because they were digging for dirt, right? They were trying to find something on her that they could use against her as a pretext for putting, a lackey in her place that's going to vote the way Trump wants. But I think that's going to be problematic if the Supreme Court says that you could fire her, because they're basically going to say that an independent Federal Reserve is not even constitutional, that the Federal Reserve must be accountable to an elected body, that they just, there's nothing in the Constitution that creates a fourth branch of government. So if they're not a branch of government, then they're part of one of the existing branches, is what they might argue. And so they may give more power to the president to, oversee these governors and dismiss them if he doesn't like the job they're doing. So I think that could be a problem. And, the tariffs, we'll see what happens with the tariffs. I think that the tariffs will be struck down, and, they're obviously unconstitutional, whether they get struck down or not. But if the Supreme Court does a good job, then the tariffs are going to get struck down. And so the question is, how is the market going to react to that? I mean, it's obviously a positive in the sense that the tariffs are not good, but the tariffs were at least bringing in revenue, not from the rest of the world, from American consumers who end up, footing the bill. But that means we're going to have bigger deficits if we don't get that revenue. And, Donald Trump has gone out there and said, if these tariffs the Supreme Court overrules my tariffs, it's a disaster. We're going to collapse. I mean, turn out the lights. The country's over. So, I mean, to the extent that people believe any of that, right, then, there could be some problems. I think the markets would be more relieved by the absence of tariffs, because I don't think people believe what Trump is saying about how vital these tariffs are to our national survival. But they will cost the government revenue. So if they're not going to get revenue from tariffs, where are they going to get it? Right? We have massive deficits as it is, and they'll be even bigger absent the tariffs.
Yeah. So obviously, the tariffs, many of the companies sold off who had a lot of their manufacturing and their imported goods related to other nations who were being tariffed. And so, thinking about that, I could see markets actually rallying, from that, but who knows? I mean, the markets have their own way of working, their own mind. But what happens to the tariff dividend? The $2,000 checks, that were promised and everything. What happens there?
Well, I mean, Trump just threw that out on a social media post at some point. So there are no real tariff dividends. It would be the equivalent of just more stimmy checks that they would be sending out, but Congress would have to appropriate that money. So Trump just can't direct the tariff revenue to households. Congress would have to approve that. Now, they may get that through because no one's going to want to stand it away between a voter and a $2,000 check. And especially, the way Trump proposed it, it's per person, not per family. So a family of four would get $8,000. Now, of course, most of that money isn't even going to come from the tariffs because the tariffs aren't bringing in that much money. So, they would just come out of the general revenue, which means you have to add to the deficits because we don't have the money. But even if, some of the money is offset by the tariffs, it still adds to the deficit because otherwise the tariffs would have subtracted from the deficit. And if we don't get the subtraction, because we've just mailed out these tariff dividend checks. But of course, the biggest fraud of the tariff dividend checks is that we're giving the tariffs back to the people who are paying them in the first place. So they're not really getting a windfall. They're just getting their money back. Now, some people might get a windfall because they may not have bought that much stuff. And so, they may win at the expense of somebody else who loses on the deal. But they also defeat the very purpose of the tariff. If the tariff is really there to discourage imports by raising the price of imports, and so we don't buy as many imported products. If the government just hands everybody a check, now they have more money to pay those higher prices. So we end up subsidizing consumers to buy the items that we tariffed. And so now they don't reduce their imports; they just keep on buying. So we don't accomplish any, insourcing of our manufacturing. That only would theoretically happen if consumers balked at paying the tariffs. But if we give them a bunch of money, then they can afford to pay the tariffs. So it really makes no sense. But it shows that Trump doesn't even understand the policies that he's promoting.
Yeah, because I'm wondering about the effort to reshore manufacturing, and obviously we had trade issues with China and the refining of rare earths and such, and that's going to take a lot of capital, and so it seems counterproductive to give out the tariff revenue to the citizens. If you're wanting to reshore this manufacturing back on U.S. soil.
Yeah, I mean, you lose that, and then you lose the revenue. Trump was talking about how the tariff revenue was going to offset the big, beautiful bill. But, according to the Trump administration, when they were at the Supreme Court arguing that the tariffs weren't taxes, which is nonsense. Of course, they're taxes. But they were trying to say the purpose is not to raise revenue. But, Trump boasted, not only after he won, but during his campaign, how we were going to replace the income tax with tariffs, and we were going to, have the External Revenue Service, and we're going to raise all this money. So to then go to the Supreme Court and say that it's got nothing to do with raising money, I mean, the Supreme Court probably saw right through that because it's clear that the tariffs are there to raise money. I mean, they were sold as a funding mechanism for the government, so.
Yeah, that's pretty. It's not surprising, I would say, to hear that from politicians. So just thinking about the recent reaction in the markets to the liquidity strain, there was some liquidity strain in the repo market where these hedge funds and big institutions needed liquidity. And they had a lot of treasuries that they wanted to offer for collateral, and that created some stress. And so, ultimately that leads to like the selling of assets and such. So we saw assets sell off significantly, obviously not the metals. What's your reaction to how the metals held up during that volatility?
Well, the metals held up really well. I mean, gold is still above $4,000 an ounce. In fact, I'm pretty sure it's pretty close. I'll check it to being back above 4,100. It's 44,080. So it's holding above what would have been a record high, like a month or two ago. And silver is above $51. So I mean, silver is above the double top that was massive resistance going back to 1980. Yeah. I mean, silver is off its peak because silver got above 54 and gold got, above 4,300. But the pullback hasn't taken us back very much. So I think the precious metals markets are in very good shape, fundamentally, technically. I think they're around their new support levels right here. Maybe, better support's a bit lower, but they're close enough. So I think they've held up really well. In contrast to, fool's gold, aka Bitcoin, has not held up well at all. In fact, earlier this morning, Bitcoin got below 91,000. Now, that's still a high price, but it's quite a bit below the 126,000 that it hit a few weeks back. So definitely in a bear market there. And in fact, in terms of gold, Bitcoin is off by 40% from its peak. That is a pretty serious bear market when you're down 40%. You wouldn't know that by listening to all the hype in the mainstream media that Bitcoin is so deep in a bear market, but it is. Because I think the best way to measure the price of gold, the price of Bitcoin, is in terms of gold. Because it's being marketed throughout the world as digital gold. as an alternative to gold. So I think gold is the proper benchmark for Bitcoin, not the dollar, especially since a lot of people that own Bitcoin don't even live in the United States. So they don't really follow the dollar as much as they follow their own currency. But I think gold is a international commodity, and everybody kind of knows its price in their currency. So I think you should you should try to measure stocks that way. And if you do that, the performance has been pretty bad in the U.S. We've lost about 70% of the value of the U.S. stock market in the past 25 years. That's not a good track record for equities.
Yeah, for sure. So just thinking about that, I mean, they oftentimes we hear Bitcoin being hard money, digital gold, and such. And right now it's still, I mean, even the tech stocks have been outperforming Bitcoin, at least on the year.
Yeah.
And
pretty much everything. I mean, Bitcoin, I think it's back in positive territory, but when Bitcoin was below 90,000, it was negative on the year.
Yeah.
And that's against better than a 50% rise in gold during the year. So that is a huge underperformance on the part of Bitcoin relative to its principal rival, right? I mean, gold competes with Bitcoin if Bitcoin is a better version of gold. If it's digital gold, gold 2.0, then, it's competing with gold. That's the position that it is being marketed to fulfill by Bitcoin instead of gold. That's the whole selling pitch. And clearly, that didn't work out very well in 2025.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Yeah. So a 40% drop in an asset that is compared to gold, or it's called the digital gold. I mean, because thinking like if gold would have dropped 40% from its highs, I mean, it would have been in the 2000s, somewhere in the 2000s, right? But Bitcoin to drop 40%, that's a significant drop for a asset that is supposed to be, digital gold or safe haven and such. And it seems like the underlying belief, whether gold is a hard asset which has thousands of years of history versus Bitcoin, which has 17 years of history or whatnot. It seems like people are believing in gold being the safe haven asset.
Well, certainly central banks, they've been big buyers of gold as they've been divesting of dollars, which makes a lot of sense that, given the trajectory of our debt, it's clearly unpayable, and either we default or we inflate. Either alternative is not good. And so central banks don't want to hold U.S. dollars. So what are they going to own instead? Are they going to stockpile euros or Japanese yen or Chinese RMB? None of those currencies look particularly promising either. They've all got their problems. But gold is the only clean shirt that's not in the hamper with all the others. Gold is the best monetary asset for central banks to own because not only can it be created out of thin air by any central bank, but you don't have any counterparty risk. If you keep the gold in your own country, you don't have to worry about a default or inflation. You've got the gold, and you can't be sanctioned. Nothing. So that's a far superior situation than holding dollars and investing them in U.S. Treasuries to get a low yield, but also leave yourself vulnerable to the whims of the United States to yank your Treasuries out from under you whenever we decide that it's something that we want to do. So yeah, this is a problem for the U.S. government, and it's going to become a bigger problem as the bond market really starts to sell off and yields really start to back up, and the Fed is ultimately going to up the size of the quantitative easing. If it hasn't already started it started, and have to print more money to buy more bonds. And then the minute they do that, well, then they make the bonds that they don't buy that much less attractive. And so now more institutions, whether it's central banks or individuals, want to get out of their treasuries.
Yeah.
And now the Fed has to buy more. But that chases even more people out. So it's there's no way out of that spiral.
Yeah. What's your view on like the big banks, the big financial institutions like Morgan Stanley? I mean, they pretty much suggested like, hey, cut half of your bonds and put 20% into gold. Do you see that as like a major shift in sentiment and the direction of where investments are going to flow?
Yeah, I think so. It's the first time in my career I've been in the investment business, I think, for better than 35 years. And during that time, I mean, other than myself, I mean, nobody really recommended physical gold who was in the brokerage industry. Certainly, if you were in the gold business and you were selling gold, you recommended it. But I don't recall a firm like Morgan Stanley ever telling their customers to buy gold. And now they're telling their customers to buy a lot of gold. I mean, 20% of the portfolio is a big number. And they're saying to take it out of, treasuries, sell your bonds and buy gold. And not an insignificant amount, 20% of your portfolio, basically unload half your bonds. And that's a big problem for the U.S. government because foreign central banks aren't buying. And now if individual investors in the U.S. start dumping half their treasuries, well, now who's left to buy the treasuries from the Treasury? Obviously the Fed. But that's very problematic because they have to create inflation, create money out of thin air and buy those treasuries so the government can spend the money.
Yeah. Yeah. I mean, it seems like why would someone want to hold the U.S. debt? I mean, we see that the deficits are sky high, national debt sky high. There's just, I mean, even unfunded liabilities are just unthinkable net numbers. And so, and obviously if we look at how inflation has impacted, I mean, us or, even just the average person, we know that the stated inflation numbers are artificially low. And so,
yeah, well, that's by design. I mean, that's deliberate because the government doesn't want to report the actual rate of inflation because now, the Fed would have to do something about it. But they don't want that because, they don't want the rate hikes or quantitative tightening. So, I think they massage those numbers quite a bit. Not that there's a conspiracy to understate them. It's just that the design, the methodology for making the computation was flawed by design. So that when you put high prices in to the calculation machine, on the other end, low prices come out. And nobody really knows what goes on in there to turn a 5% price increase into a 1% price increase, but that's what happens. So I don't even put much stock in it. And, and not only do they understate how much the cost of living is going up, they overstate how fast the economy is growing. So those numbers are very suspect too, because if you don't accurately account for inflation and you just look at the GDP going up, you may conclude that it's going up because the economy is growing, but it may actually be going up because prices are going up, and that's it. And that's being driven by inflation.
Yeah. Okay, so back to an earlier point, I kind of mentioned the Fed, pivoting and stimulating into a bubble. I mean, we already have a AI bubble. I mean, obviously Bitcoin, just fell 40%. But I'm kind of wondering, like, okay, how long can they keep this gravy train going? I mean, it seems like, when this bubble pops, it's going to be catastrophic. And so I'm just curious on your assessment of that. Do you think this is going to, it seems like it's forever how they just keep, inflating, even when the bubble, deflates some. And so just curious in your perspective there.
Well, they're kind of committed here where they've already got so much kind of in the pot that they just got to keep calling every raise, right, from the market. because the minute they stop, that the game's over, right? Everything's going to implode. So they keep pushing this, and eventually it's going to blow up because they're going to destroy the currency. That's what's going to happen, right? The dollar is going to fall through the floor, and prices are just going to accelerate rapidly. But the Fed is figuring, well, we don't know when that's going to happen. It may not be for a while, so who cares, right? Somebody else might be in charge. There'll be a new Fed chairman. There'll be a new president. So what do we give a damn, right? All we got to do is make sure that the wheels don't come off the bus now while we're all here. And so that's what they do.
Yeah. So, thinking about the bubble and, even next year we have, midterm elections and recent elections. We got the first, I think the first socialist mayor in New York City, which shows like a shift in sentiment in terms of, how voters are kind of shifting. And so I'm curious about your thoughts on midterm elections next year. Obviously, they can't afford a market crash or something catastrophic like that, especially when so much wealth is tied up in this bubble. And so curious in your perspective on next year's midterms.
Well, I mean, voters have been voting for socialism for a long time now. The only difference is the Democrats, and in some cases Republicans too, didn't admit that they were socialist. They just advocated socialist policies that were appealing to voters. What's different now is that they've come out of the closet, right? So before, you wouldn't publicly admit you were a socialist, even though that you were advocating socialist type programs. But now it's kind of okay, and maybe even a positive, to come out of the closet and say, yeah, I'm a socialist, or I'm even a communist, I'm a Marxist. And people are voting for that. That is the problem. They're knowingly voting for socialism, as opposed to not understanding that they were voting for socialism. And I think that trend is going to continue. I don't think that New York is going to be a one-off, isolated event. I think you're going to find more professed socialists on the top of the Democratic ticket in more than just New York. And I think they'll win. They'll certainly win in the Democratic primary. Probably most of the primary voters are socialists, whether they want to acknowledge that or not. That's probably the case. But we even have a lot of socialism now in the Republican Party, because a lot of what Donald Trump is doing with micromanaging the economy, central government planning, looks very much like a form of socialism. So we got both sides, moving in a socialist direction. That's not good.
Yeah. Do you think we'll ever get back to if we'll ever get back to like a pure form of capitalism, or at least on that trajectory? Do you think that'll ever happen?
No, well, we haven't had pure capitalism in a long time. If ever, right? There's always been some degree of government interference with the functioning of the market. But by and large, the capital has been left in private hands, which is a key part of it. And we have competition, the profit motive, and all that. But the heavy hand of government has gotten heavier over the years, with more regulation and more taxation that tilts it away from pure, capitalism to, more of a form of fascism, corporatism, where the government is really through the back door kind of, controlling companies with excessive regulation and taking enormous pieces of their income through taxation rather than confiscation and outright ownership. They kind of equitably take ownership by getting so much of the profits sent to them through either the profit, the corporate income tax or the payroll taxes on employees that the employer collects and then sends the money to the government, right? So the government gets that money, not the corporation. I don't know. What did you ask me?
No, yeah, I was just wondering, will we ever get back on that path? It seems Trump was headed towards that path a little bit, with reducing government, how big government was, and, the Doge.
Yeah, look, no, right now, I think there's no appetite overall for less government, because Nobody wants to give up Social Security that they've been promised, or Medicaid, or their government pension. And so if you're not going to give that stuff up, there's no meaningful cuts in government spending that are coming, because entitlements are where it's at. Right? That's where the bleeding is, plus interest on the debt. Now, the only way to do something about interest on the debt is, one, stop running up more debt, right? Because we're adding to the problem. But that would require significant cuts and, restructuring the debt, honestly, and fessing up that we can't afford to pay. And of course, that has a lot of ramifications, but I ultimately think that's the direction we should go in. But we're not going to do that. We're just going to print money and destroy the value of the dollar. Because when you do that, when you resort to money printing, right, you slash interest rates and print money, the negative consequences don't come immediately. It could come 6 months later, a year later, 2 years later. You don't know for sure. And politicians can always deny responsibility to the extent that anybody wants to assign the responsibility to the politicians. They say, look, it's not our fault. We didn't do that. We didn't jack up the prices. That was speculators, or that was these greedy corporations. If they pursue these policies and there is an immediate consequence, like if they decide to do the right thing and cut Social Security, cut Medicare, there's a crisis right away. And there's no question as to who they're going to blame. I mean, how can the politicians who vote to cut the entitlements point fingers at somebody else, especially people that didn't vote? So nobody wants to do that. Nobody wants to do the right thing and then be held accountable for the short-term pain. They'd rather, kick the can down the road and push the pain into the future, even though it means more pain, more excruciating pain. But they can deny responsibility for that, right? Because there's not a clear-cut connection between what they did and something that happens a year or two into the future.
Yeah, that is true. Because I've definitely been thinking about the Social Security fund. The trust fund is scheduled to run out in, I think, 2033, somewhere around there. And there's no, we're not bringing in enough funds to even keep that even alive. So,
and it doesn't even, when you talk about running out, the only thing they have is U.S. Treasuries. And they're running out of something that the U.S. government creates out of thin air anyway. So it's just an accounting to say that, because they're already out of money, right? Because they're already in the fact that they're not collecting enough taxes to pay the benefits, right? The tax revenue is insufficient to pay the current benefits. So the reason that Social Security hasn't defaulted on those commitments is it's still getting revenue, or rather it still has bonds left over from prior excess contributions. But those bonds, that money has already been lent to the U.S. government and spent. And the U.S. government stuck an IOU in the so-called trust funds. But the only way the trust funds are spending this money is basically cashing in their IOU. The government is having to repay the Social Security trust fund now because it's having to borrow extra money to repay the Social Security trust fund. And so even if the funds were already empty, mechanically there'd be no difference. The government would still have to sell bonds. So we've already reached the point where the program isn't funded anymore by its tax revenue. It's completely dependent on the government going out and raising revenue, through taxation or through inflation, quantitative easing.
Yeah, definitely. Okay, so just as we wrap up, Euro Pacific Asset Management, you all have multiple different funds, obviously commodities and such. And I'm curious in which metal are you most bullish on at this point? I know you're bullish on all of them, but if Peter had to pick one.
I'm bullish on commodities in general and precious metals in particular. But I really been liking silver for a while because I think it has a big catch-up trade to gold. And I think that as the precious metals bull market broadens out beyond central banks, so central banks have been the big buyers of gold. But when the public really gets in, I think they're going to buy a lot of silver. And so that's going to create a lot of demand for an asset that's in scarce supply. And the silver gold ratio is very much in favor of buying silver. Silver is still very cheap historically. It's not cheap relative to dollars, right? Because it's at a record high. It's above the double top from 50. But in terms of gold, how much silver you buy today for every ounce of gold, silver is very cheap. So I think that's going to be a metal to own. It's going to benefit from demand as a safe haven, as a monetary metal, but also real world demand, for silver, which is used in a lot of things, especially related to, let's say, electric power and things like that. And so silver prices got to go up. And these silver mining stocks, I think, are very cheap. We've got exposure to those in my gold fund. In fact, even one of my, I think my value fund even owns a little bit of a silver stock, just because we thought there was a lot of value in that sector, so I'll put it in the value fund.
Yeah. What's your take on oil? Oil's been struggling, and there's many charts of gold to oil ratio, gold to oil to silver ratio, and such. And so, curious in your perspective on oil.
I mean, I think oil is bottoming around this $60 level. I think it's cheap. In terms of gold, it's really at a record low. If you throw out like a month around COVID when oil went negative, and it didn't really count. But oil has never really been this cheap for mining companies relative to the value of the gold they're mining, how much oil they can buy to help bring it out of the ground. So all this is really good for gold mining stocks. And, it's not even really factored in there yet. But I do expect the price of oil to take off, any day. It could happen any time. So that would remove some of that positive for the gold mining stocks. But I also own a lot of oil stocks. And of course, so that would be very good for my oil stocks to see the price of oil move up. Now, it's not necessarily good for the U.S. economy to get more expensive oil. In fact, it's bad. And it's going to put more pressure on the Fed to create more inflation to try to stimulate the economy from an oil shock, to the extent that we get, a larger jump in the price of oil in a short period of time, which could happen given the fact that the prices are really low right now.
Yeah, definitely. Okay, and then you have emerging market exposure. You mentioned your value fund as well. Just curious in your overall take on the emerging markets. I mean, obviously they're a lot cheaper than the U.S. Stock market valuations and such. And so just curious in your overall perspective there.
Yeah, well, emerging markets, are cheap in a relative sense compared to developed markets, and they have been for many years now. Over a decade, I think they've been cheap. In fact, they've been the cheapest they've ever been. So as a value investor, I like that. I like to buy stuff that's as cheap as it's ever been. And I think that if I'm right about what's happening with the de-dollarization process and the fact that foreign central banks are not just randomly dumping dollars and buying gold, they're doing it for a purpose. They want to back their currency with gold more than dollars. They want to make this shift in the composition of their reserves away from dollars and treasuries towards gold for a number of reasons: political, economic, all sorts of reasons. Validate that transformation. And so if that is going to be ongoing, it has, I think, big impact on the emerging markets, because if the dollar really gets hit, which I believe it will, I think that the losses will be particularly, high against the emerging market currencies. And so that's going to deliver a lot of new purchasing power to consumers in those economies. And that's going to stimulate all sorts of spending, because their money will go a lot further, because their costs will be a lot lower relative to their own currencies that have appreciated. And I think that will also enhance the investment returns in those assets with currency gains. So I think more capital is going to flow in there. They're going to benefit from a more enriched households that can spend more and invest more. And, as they consume more of what they produce, they won't be loaning as much money to America, and therefore their savings will be invested more productively domestically than loaned out to the United States, to buy houses or whatever we're doing with the money.
Yeah,
And so I think this is going to benefit earnings in those countries, economic growth. Their stock markets are going to follow. I think it's like a big burden is going to be lifted because the lion's share of the burden of maintaining the U.S. dollar's reserve status has been borne by these central banks because in these emerging markets, because they are producing so much of what we consume. That's a massive subsidy. They're lending so much of what we save. So I think to the extent that they're no longer burdened with that, that's going to be like a huge weight lifted from their shoulders, and they'll be able to move around a lot faster and a lot more efficiently without having to carry us. America is going to be in trouble because now where are we going to get all our stuff, right? All the stuff that we now import, where are we going to make it? How are we going to buy it? I mean, that's going to be very challenging. The job that other countries have is not challenging at all. It's actually quite enjoyable. Just consuming what you produce, that's pretty easy. Yeah. And the methodology for that is prices come down. So, your currency goes up, and so your prices go down. And so more of what's produced in China stays in China, gets consumed in China. So the Chinese enjoy it, not Americans.
Yeah. Yeah, it was pretty interesting in the recent sell-off and volatility. My emerging market stocks were holding up fairly well, and so that was pretty interesting. So thank you for sharing where the opportunities lie, Peter. Where can people find you, connect with you, buy some gold, silver, whatever you want to pitch?
Well, certainly if you're interested in my investment strategies and my mutual funds, you can get plenty of information at the website above my shoulder at europac.com. We have separately managed accounts. We have mutual funds. All the mutual funds, too, are available no load at any discount brokerage firm that's there. We're on all the platforms. So you can get all the symbols, take a look at the prospectuses on the Europac website. Everybody should have some money in silver and gold. Right now, in particular, silver. But you can buy both metals at Schiff Gold. And in fact, I'm developing a new platform right now on the Schiff Gold website. You can go directly to it by going to tgold.com. And the T stands for trade, but it also stands for tokenized gold, because ultimately I'm going to be tokenizing gold and having a gold-backed token that is a true stable coin, because it's stable to something that has stability, gold, as opposed to something that lacks stability, like the U.S. dollar. But in the meantime, I have this platform where people can buy gold in any dollar amount. So you don't have to buy a weight of gold or, 10 maple leaves or, 20. Just buy $100, $1,000, $5,000, $10,000 worth of gold or silver, and it will be credited to your account. But what I want to have ultimately is build out an ecosystem where people who are customers and have gold can trade it amongst themselves. So if you have a small business and you're providing a service or selling a product and your customers have an account, they can pay you in gold. You can receive gold in exchange for, your goods and services, or you can pay if somebody else, prefers to be paid in gold. You could do that. And I want to issue debit cards and secured credit cards backed by the gold. So people, carry their gold around in the app on their phone or in a card in their wallet. And it makes the gold extremely accessible to the extent that you need to use it. Right?
Yeah.
So it's a great store of value when you have a bar in a safe. But, if it's 12 o'clock in the morning and I need cash, I can't really get my gold. But if you have this app, you can immediately turn some of your gold into cash and pull it out of an ATM machine or spend it, so it makes it very, very simple to access your gold. And I think as more people come out of fool's gold, as the air comes out of this Bitcoin bubble, I think a lot of people are going to appreciate the benefits of a tokenized gold or the gold platform that I'm building out at T-Gold, to the extent that they want to use gold as a way to get out of the fiat system and, engage and, can perform commerce using gold. That's very easy to do, much easier than doing it with Bitcoin. And it's much less expensive, much faster. And, you have the added benefit of having a store of value, which Bitcoin is not. I mean, people confuse the fact that Bitcoin's price has gone way up with Bitcoin being a store of value. It's not a store of value because in order to be a store of value, you have to start off with value that you could store. Bitcoin starts off with no value, so you can't store what you don't have. But what Bitcoin does have is a price, and that price is a function of supply and demand. But you can't store a price because the price could collapse, right? You have no control over the price. The market sets the price. But the main reason that people want to buy Bitcoin is because they think it's going to keep going up in price. They think that if they buy it today, some greater fool will pay more for it tomorrow. And so that's why they want it. It's all speculative demand. But at some point, that demand is going to dry up, and then there's no reason to own Bitcoin. I mean, if you don't think you're going to get rich off of Bitcoin, then why own it? I mean, what does it do? That's all it does. And of course, it doesn't actually do that. People just are hoping that it's going to do that. Now, some people have already gotten rich on Bitcoin, and other people are hoping that, lightning is going to strike twice. But the problem is, buying Bitcoin at $1, and getting rich because it's 100,000, you made, 100 times your money, or a lot more. Actually, no, a lot more, 100,000 times your money. Whatever. It's not going to do that again from here. I mean, the people who are even saying, $1 million Bitcoin, $10 million Bitcoin, that ain't going to happen, right? But people still believe it might happen, and that's why they want to buy Bitcoin. It's not because they need it, to use it for anything. They're buying it because they're convinced that, they'll get rich. But as people start to doubt that thesis and want out of Bitcoin, that's going to be a big problem. But a lot of that money that they're able to get out, I think, will find its way into gold and silver. But so go to Schiff Gold and get physical gold, or go to T Gold and sign up for an account. In fact, everybody should do that because you can put in $50, $100, whatever. I mean, obviously you should buy more gold and silver than that, but there's no real minimum. So you can just set up an account and then start buying gold and silver and accumulating it. The other benefits, the debit card, the tokens, all that's coming later. I haven't added that on yet, but I'm working on it.
Okay. Well, that's good to know. Well, appreciate you plugging the audience for that. Appreciate the innovation around gold and silver as well. That you all are
and
working.
then, and forget, the other people could find me online. They can listen to the Peter Schiff Show podcast on schiffradio.com, on my YouTube channel. Follow me on X. I'm out there on social media. And I do have a newsletter too, a free newsletter that comes out several times a week. You can sign up for it at schiffsovereign.com. A lot of good material we're putting out constantly. People really enjoy reading the stuff that we put out. And we do a lot of investment research too that we have in some paid publications. People also, might have an interest in trying that as well.
Okay. Yep. Got it. Well, you all have the sources from the man himself. Peter, appreciate you for coming on the show and look forward to having you back sometime.
All right, Daryl. Thanks a lot.